morning. My name is CATHELYN GRIFFIN. I am the Communication Director for Security Investments Company. This morning, I'm excited to be interviewing a legend in the investing techniques in our technical market and analyst, Mr. Roy Idrach. Mr. Idrach's career in trading goes back to 1972. That's about 48 years of experience in stocks and commodities trading. Mr. Idrach owns and manages a private investment fund. We want to give the most sincere thanks to all the participants who submitted questions for this interview. We received hundreds of them, but due to the time limit, we are going to cover as many as possible. And now we would like to welcome Mr. Roy Idrach.
Thank you, man. Thank you. It's a pleasure to be here today, and I'm very pleased that you're inviting me to this interview. So I guess we'll go ahead and start. Do you have any questions for me today?
Yes, sir. How are you doing this morning, Mr. Idrach?
Oh, I'm doing okay. It's been a long journey, 48 years of this business.
Wow, that's a long time.
Yeah.
So tell us a little bit about yourself and how did you get started into stocks and commodities trading?
Well, I started back in 1972 when I was about 32 years old. What really happened was that I didn't know any better, like most stocks investors do, and the broker kind of took advantage of me. So I had to get a job to keep on working and survive. I just was making rich the representative from the broker company, and I never made any money. Eventually, I learned how to get around those things and learn, and then here I am today.
Wow, Mr. Idrach, sounds like you have lived a very exciting life. As you know, we have some questions. Our first question is from a student in Houston, Texas, and they want to know why long-term investing beats short-term investing.
Right. Short-term investing, you don't give enough time to the stock to actually gain the proper value where they can benefit and profit. So when you do short-term investing, or it's more like a trading and you're actually gambling. The long-term investor is totally different because the long-term investor, you take, for example, Shopify. Shopify 5 years ago, you had put $5,000 into it, you will have today about $700,000. If you have invested $50,000, you will have $3.5 million. So long-term, years into it, is more productive than short-term.
Oh, wow, that's very valuable information, Mr. Idrach. Now, what is your opinion on long-term investors and day trading, and what do you think about employers' retirement accounts for their employees, like their 401ks and so on?
Okay, this is a very kind of complex situation, Okay. So we're going to divide it into two parts. The long-term investors do better in the long run. One of the reasons is that the compound effect of their investment. The investment, as it grows, they pay dividends, and all that it multiplies its value, they can be reinvested. A long-term investor can invest on an index fund, and the compounding effect of the index fund has a multiple return through the years. You also can add more money monthly to the index fund, and therefore, at the time, compound all the interest, earning on interest and dividends. Eventually, in a long term, you can have millions of dollars invested.
Oh, wow. I never realized the impact of how our life, how much it costs us. I have a text question for you from someone that is watching our interview live. And this person would like to know, what is selling short and how does it affect the price of the assets or stocks?
Okay, let me go back a little bit in regard to the retirement account. On the retirement account, you got a situation where they got multiple ways of doing it. This is the second part of that. For example, you pay into the plan and your employer might or might not contribute to your retirement. You take like federal employees, you get a different retirement that teachers have and municipal have. But all of them have one thing in common. They got management fees. And those management fees are very dangerous because people don't realize what happened. Some of them charge 1%, some of them charge less, but you gotta realize that you're putting 100% of the money into it. You're taking 100% of the risk into it. They just manage the fund, so they don't have no risk at all, but they charge a fee of 1% per year, or 0.75, 0.75%. The thing is that you take somebody that put 40 years into the career and put them to contribute into the investment for the retirement account, they take in 1% a year. So you multiply 40 years at 1%, you put 100% of the money, but you only get 60% back because you have been killed by the 1% that is charged every year. So by the time you retirement, you only get 60% of what you invested. And I don't think that's right. Now, going back to the selling short is a very tricky situation. When you sell short, it's meaning that you're selling something that you really don't own. And here's the part. The brokers say, well, I'm borrowing the stock from the broker in order to do this. Well, how do we know even the stockbroker have the stock? The part of selling short is that one of the first things that happen is that you're taking a lot of risk. If the short seller, the price continue going up, you have to make up all the losses. And that could be very risky because it's unlimited losses. And these losses can take you to a margin call, meaning that the broker is going to call you and say, hey, we need cash money here right away. And it can be very large amount of money. And now you find yourself selling your home and your children in order to pay the broker.
Yes.
That's one of them. The other part is that on this type of trade, you gotta understand the factors that are involved. One of them is that when you sell something short, it counts as a selling stock. As the price drop and you buy, it counts as buying stock. So when you sell short, too many people sell short, what it does is that it drives the price down automatically. So it all depends. So you sell short and not too many people are traders and selling a short, they are buying. Now they drive the price up and this is where you get the margin call. So it affects both ways. When you sell a short, it's supposed to drive the price down. It all depends how many. When you buy it back, it comes as the price goes up. Like if you're buying or you're actually canceling the order. And of course, you see the price goes up and you say, oh, the market is going up, the price is going up. But it's going up, the price is going up because what? Somebody's selling or somebody's buying, or is really the short seller buying the stock back to take the profit. So we have to interpret what's going on, or else you jump in and thinking, look, it's going up. And then by tomorrow, 2 days later, there's no more short buyer and the price collapse. So you go in at the timing, at the wrong time, you can lose a lot of money.
Okay. I'll bet very few people realize how the inside working of the markets functions. Can you give us an example of a stock order flow and free commission?
Right. The stock order flow is very interesting because what happened is that you take somebody like Robinhood. Robinhood was the first company that started a non-commission business. Now everybody do non-commission. But Robinhood really what it do is they pass through the order to somebody like Citadel or some other broker, and then the settlement of the price of the stock, they get a commission off of that. So they're not really free. It just sounds like it's free, but they're not. They say no commission, and what happened is that the market makers take, for example, the stock is I buy, right? And he might buy at a lower price than the stock really is. So then again, there's another spread. So let's say, for example, that I order 1,000 shares, and it used to be that we pay $5 for 1,000 shares. Then the price of the stock was more fair, and therefore it might be just 2-3 cents different between the price and the actual price. Now, when we put 50 cents or we put 25 cents into in 1,000 shares, Now the market maker is making $500 on 1,000 shares, when before they used to get only $5. So it's a better deal for them, but not for the actual retail trade. Especially a mutual fund will be treated different because the large amount of volume that they buy millions and billions of shares, so they get treated different. The little guy is the one that gets hurt. So there's no free lunch on this business.
Well, very interesting. So we pay one way or another.
That's exactly right. We pay one way and another.
Okay, we do have a question about what is the 90-90-90 rule, and can you explain it?
Yeah, 90-90 rules is very interesting. For example, what happened with the 90-90 rule is that the short-term retail trader investor, it gets short-changed out of his money. They go and open an account, they put $500, $300, $5,000 or whatever. And brokers know already. You go on TV and you see this advertising every evening from different company advertising to open an account. Why do you think they're doing that? The reason they're doing that is because they are replacing the account that went broke or they cannot trade because they don't have the money. So they know already for a fact that they have to spend 60% of the money to bring new traders into the floor because they depend from them. Mm-hmm. So if they go broke, he don't trade anymore. He don't buy or sell. So how are they going to make a living? Those guys need to get paid. Advertising has to get paid. Building renter has to get paid. So it's not free. So what happened here that they already call it a rule, 90-90-90 rule, because 90% of the investors lose 90% of the money in 90 days. 3 months later, they're broke or they don't have enough money to trade.